Hey, welcome back to the channel, folks. My name is Jason, host of Fighting Words Financial. And today we are going to talk about semiconductor stocks. And of course, any other questions you guys bring up too, I'm happy to talk about as well. But I really wanted to talk about semiconductor stocks because that has been a topic that is frequently asked about on my live stream. So I'm happy to talk about that today. Did want to briefly go over what's going on in markets today. We had markets drift a little bit here. The Dow Jones is up 239 points, or about 0.7% as of right now. Tech is dragging down the Nasdaq right now. It's down 31 points, or about 0.2%. The rest of the indices are basically flat, with the S&P only up 7.66 and the Russell 2000 down about 0.1%. Once again, we are looking at energy being one of the biggest losers, along with real estate, technology, and healthcare. So that is the markets today as what's going on right now. And we are looking at a lot of our favorite stocks, the Chinese EV stocks. Those are going to be posting earnings later on this week. What their earnings look like actually isn't my main concern about what's going on with Chinese EV stocks. They're all solid companies at this point, and they're all doing very well in terms of building out their industrial capacity to meet the ever-soaring demand for electric vehicles in China and abroad. My main concern right now is geopolitical concerns, whether or not they're going to be listed a year from now. And I'm growing more and more cautious about that. So, yeah, but let's talk about semiconductor stocks. Fire away with the questions that you might have. So I've been asked about this a few times on my channel in the last couple of weeks. And I give answers kind of piecemeal as far as which stocks I like, which stocks I don't. I listed a bunch of stocks in the description here of this live stream. All stocks for you guys to look at, to investigate on your own. Once again, nothing that I talk about on my channel is a recommendation for any individual to go out and buy, sell, or hold any security. You cannot give advice like that through a YouTube channel, and you shouldn't expect that any of that advice is actually aimed at you, even if I'm directly answering one of your questions. But let's talk about how the semiconductor industry is changing. So I've been investing in semiconductor stocks for roughly 25 years now. And after a very, very rough beginning in investing in semiconductor stocks, I figured out that it's just a highly cyclical industry, and it's usually dependent on demand for one or two consumer devices. That entire industry is changing, and I've long felt that the semiconductor industry was going to begin to become a lot less cyclical. And I found a blog post from PIMCO that really supports that position. And let's talk about that right now. So if you don't know who PIMCO is, they're one of the largest money managers on the planet. They're probably best known for their fixed income management, although they do a ton of equity management as well. And they're generally more accessible through the institutional side, through like pension funds, 401ks, and that sort of thing. And they don't do quite as much retail business, largely because of their concentration in fixed income. But as we are taking a look at what they have to say about semiconductors, you're going to take a look at some of these graphs too, and you probably will understand what they're talking about here. Semiconductor is a less cyclical future. A sea change is occurring in the semiconductor industry. Once notorious for boom and bust cycles that revolved around demand for a few consumer devices, the chip industry now powers most aspects of our economy. This proliferation, in our view, will help smooth steep cycles and drive durable demand even as the economy slows and recession risks increases. And they go through a lot of data that supports their position as well here. Yet chip stocks still trade at a discount based on the cyclicality. Basically, I don't know how to pronounce that quickly, in the 1990s and 2000s. So it's basically priced right now, assuming that these stocks are going to emulate the cycles that semiconductors went through in the 1990s and 2000s. We think that this represents an attractive opportunity for investors ahead of what we believe will be a market reevaluation to higher multiples as earnings prove more stable than previous cycles. And I agree with that, largely because the non-consumer demand for chips has risen to a level that we've never seen before. So historically, semiconductor manufacturing ran in boom and bust cycles correlated with global GDP growth. Insatiable demand for a consumer product such as PCs in the 1980s mobile phones in the 2000s, and smartphones in the 2010s. Would lead manufacturers aggressively expand capacity, and they usually did. That would lead them to aggressively expand capacity. Supply eventually exceeded demand either through overproduction or an economic downturn, sending prices and revenues down and ending the lives of many of these companies. A new end product or economic recovery would reignite the cycle, reflecting this cyclicality. Equity investors historically have paid lower earnings multiples for semiconductor stocks. But we believe these sharp peaks and valleys are a thing of the past. Recently, semiconductors have become nearly ubiquitous, a key component in numerous industrial applications, leaving the industry far less vulnerable to single retail end markets. Many of these new end markets, such as autos, industrial automation, 5G infrastructure, artificial intelligence, and cloud computing, require more chips per unit and have longer cycles than computer electronics, lessening the industry's reliance on consumer spending and potentially smoothing revenue. One of the fastest growth markets is likely to be automotive. An electric vehicle currently uses more than twice the number of semiconductors when compared to its internal combustion engine counterparts. And industry experts expect this gap to widen. And what we're looking at here is a chart of demand continuing to diversify beyond the consumer. So consumer demand for things like PCs, smartphones, TV, et cetera, those have declined over the last 10 years or so. And we're looking at non-consumer demand for things like AI, cloud, autos, industrial, increasing over time. So I think this represents a sort of shifting narrative and shifting perspective on the semiconductor industry. The company that I'm going to talk about today definitely doesn't represent value in the traditional sense. It really hasn't taken a hit from market swings like other companies have, but it is connected to the semiconductor industry in a way that you might not really think about. So so the industry supply structure should too, in our view, support more stable earnings cycles in the future. After a decade-long wave of consolidation, the semiconductor industry now exhibits an oligarchic structure with high barriers to entry and significant pricing power. Suppliers adhere to more stringent return requirements on capital expenditures, which are increasingly funded by upfront payments and government subsidies across Asia, Europe, and the United States. And this is, of course, reflective of the U.S.'s investment in the CHIPS Act and the sort of general desire to reshore chip manufacture here to the United States. So strong balance sheets. And this is when we get into the numbers and current cash flows. Amid strong demand and pricing power, the larger semiconductor companies have built a solid balance sheet with strong cash positions and little to no debt, providing resilience in an economic slowdown and higher borrowing costs. Over the last decade, many companies have used excess cash to increase dividends and buy back stock, a trend we expect to continue. So most of these semiconductor companies pay a small dividend, and we're probably looking at dividend increases going forward and more stock buybacks, which is going to help support the price. So the semiconductor sector offers an appealing combination of quality, attractive valuations, and a strong earnings outlook. First of all, is growth. We believe the sector will grow earnings in the 15 to 20% range over the next 2 years, well above market, and continue double-digit growth and margin expansion, which margin expansion is really impressive here. We expect secular tailwinds and shortages of production capacity to fuel strong pricing power while dampening economic sensitivity. Meaning that supply is still going to be short and demand's not really going to decrease, and they're going to have a lot of pricing power. They're going to be able to raise prices. Less cyclically sensitive applications seem likely to further drive industry growth even as the economy weakens. Smart energy infrastructure, labor force automation, and electric vehicle adoption are only partly through a multi-year period of growth. Visibility to future revenues has improved. The industry has moved towards long-term, non-refundable contracts with capacity booked out to 2023 and in some cases 2024. Tight capacity promises to bolster revenues at equipment manufacturers well beyond 2022. So this is the most interesting thing here, is that margins from May of 2012 were anywhere from gross margin at 5%, operating margin at 12.5% or so. Those have grown to roughly 53% for gross margin and operating margins around 55%. These companies have a really, really large cushion in terms of pricing power here. So let's take a look at valuation here. As of June 6th, PHLX semiconductor index traded at 17 times forward earnings at a discount to the Nasdaq index, which trades at a forward multiple of 23. Underneath the surface, we see even larger discounts with some companies trading at single-digit multiples. We see room for future multiple expansion supported by the industry's more stable earnings outlook. So they favor owning a well-diversified basket of semiconductor equities across the supply chain from end chip makers to equipment manufacturers to materials providers. This approach reduces concentration risk, and we believe the sector will continue to post consistently strong earnings against a backdrop of a slowing economy, inducing the market to recalibrate expectations in line with fundamentals. Essentially, what they are saying is that they believe that the entire sector is undervalued at this point because it's based on how the semiconductor cycles worked in the past. I tend to agree with them, and I was not able to articulate that in the last couple of days, really until I read this article. And so, of course, this is not me articulating it. This is me just reading the article. I think this is important to look at here, and I'll drop this article in the comments right here if you guys want to read it afterwards. So didn't want to remind you today, guys, that the super chat features are on if you feel so inclined. If you aren't subscribed to my channel, feel free to do so. Drop a like on there for the algorithm so this can be seen by more people. And yeah, so let's look at questions and comments here. I guess everyone's still yahooing over Bed Bath & Beyond's crazy day. Why not many here? I think that has to do with people here probably being a bit more long-term when it comes to investing, trying to catch, a stock that's going meme crazy has left a lot of people burned. Like a lot of people that I spoke to after a video I made on Wunong Net Technology, like a year and a half ago, they ended up writing me back like months later saying they basically lost everything. And a lot of people have gotten burned on meme stocks that have made money. But I do congratulate everyone who turned a couple $1,000s into hundreds of thousands of dollars. I'm very happy for you. I think that's awesome. So, so Stitch Fix was the other one that was up today, which is very, very interesting. I took a look at their business a while back. I wasn't incredibly impressed by it. There could be some meme action going on with there as well. So, wow, dude, 80% up on Bed Bath & Beyond. That's amazing. So Ray Dalio's Bridgewater got on most of their Chinese stocks, Baba, DDY, etc. I'm not sure. I have a very good idea why. It looks like China's collapse is accelerating at this point, and the government's going to have to step in to save the banking industry and to save their fixed income market. Their fixed income market is nowhere near as mature and robust as ours is, and they're probably going to have to step in and backstop a bunch of things. So, I think that's very interesting that they were still holding DD after it was delisted and traded on over the counter as well. So, yeah. But let me know what you guys think about this. I wanted to cover this stock right here. So I did sell some puts on this stock today, largely because I am bullish on it. It doesn't represent extreme value, but let's talk about, and they report their earnings tomorrow, and this is Synopsys. Synopsys is not a chip maker. They do something completely different. So, but they are, see here, and I'll get to this question. What about ASML? Hopefully plenty new fab factories being built in the US. Yeah, I'll get to them in just a minute here. Okay. But we'll definitely talk about them. So Synopsys is slated to report third quarter fiscal earnings results on August 17th. The company anticipates revenues between $1.21 billion and $1.24 billion for fiscal third quarter. The Zacks consensus estimate for the same is pegged at $1.22 billion, suggesting growth of 15.6%, which is sort of right in the middle of the estimate for that article that I read a minute ago. Synopsys expects non-GAAP earnings to be between 2.01 and 2.06 per share, and the consensus estimate of 2.04 per share indicates an improvement of 12.6% year over year. I actually expect them to beat earnings at this point. One of the reasons I sold puts on this stock, if the stock doesn't go down, I'm happy to just pocket the money. If the stock does go down, I'm happy to buy it at the level where I sold the put. Investing in any semiconductor stock, though, in the past has been highly volatile over time. I think that the The beta for the stock is about 1.22. So it's about 20%, 22% more volatile than the overall sector. So yeah, so facts to consider here. Third quarter performance is likely to have benefited from growing demand for its solid product portfolio. The increasing global design activity and consumer engagements are likely to have been growth drivers. The rising impact of AI, 5G, Internet of Things, and high performance computing. Interesting that they mentioned Internet of Things in this article, especially after looking at PI's performance over the last couple of months. The cloud and automotive is anticipated to have boosted demand for Synopsys's advanced solutions during the quarter under review. Synopsys' performance is likely to have gained from growth in custom compiler, which is used to fuel large deal wins in the 5G, AI, and server chip markets. This is probably the reason that I expect them to significantly outperform. So it's the ongoing shift to high performance cloud computing due to the high growth hybrid working environment is expected to have aided demand for the company's intellectual property solutions, such as peripheral component, interconnect, Express 5.0, 6.0, and 800G Ethernet DDR. So let's talk a little bit about what they do. Largely because this is a company that you may know of just because they're out there and their name is mentioned sometimes. But just a moment here. So when we take a look at their actual stock here, like I said, this is not a stock that you would look at and say, oh, this one's beaten down. They're pretty close to the top range of their 52-week range. So the highest point they've been is at $391 a share. Right now, they're about $385. They're down a little bit post-market right now. They do report earnings tomorrow. Volume is healthy, but not exactly robust. It's at 676,000 shares changing hands, an average of about 1 million shares trading hands per day. I think a lot of people are kind of sitting on this and waiting to see what happens. Market cap is $59 billion or so. Earnings per share is $6.56, and price to earnings ratio is high for the industry at $58.79. So, and it's pretty close to a consensus 1 year target estimate right now at 388. So, like I said, it does not represent value at this point by traditional metrics and by current cash flows. What I'm really looking at is future cash flows here. I would prefer to acquire the stock from my personal portfolio at a lower price point than this. $255 a couple of months ago per share. It certainly looked a lot more attractive then. But yeah, so let's talk a little bit about what it is that they do, and I'm going to make an important point about the earnings here. So Synopsys provides electronic design automation software that product designers use to design and test integrated circuits. And that's really the bulk of what they do is they provide the design platform to design chips. Okay. The important thing is we can look at mean recommendations here. There are a few holds in here, a couple of buys and a couple of strong buys. Earnings and revenue look good, really good, steadily increasing at a rate of about 15% annually for the last 4 years. Here's what's not on this chart. They have not failed to increase revenues since 2005. And they've only had a few quarters where they haven't increased earnings since 2005. This is a solid company with a great suite of products that's out there that's only becoming more and more in demand as the breadth of the type of semiconductors that we need just keeps growing and growing and growing. This is a stock that you should certainly have on your radar. So let me see here. Between AMD, NVIDIA, and Micron, which chip companies do you think will outperform? I don't know much about chips other than they're used in electronics. They're using so many products out there that you may not even realize, including they're used to run equipment that doesn't directly use chips as well, especially when you're talking about Internet of Things like impinge products and things like that. So I wouldn't necessarily take a concentrated bet on AMD, NVIDIA, and Micron, either all three of those. I do have a concentrated bet on NVIDIA. It is an incredibly volatile stock, though. I'm willing to ride out that volatility. If you wanted to reduce your volatility, I think that AMD would probably be the better bet. I think that NVIDIA is going to outperform over time. They just have their feet or their irons in a lot of fires right now. Micron is the one that I'm probably least impressed with right now in terms of their product lineup. So yeah, but that could all change in the future. Everyone is rapidly innovating. Everyone is racing to get new products to market, and long-term contract or delivery contracts for all of these countries, they are companies, they are booked out until 2023. I think that the article that I read or the blog post that I read from PIMCO is spot on. Is that this time, although we're seeing a reduction in demand for PCs, a reduction in demand for gaming, it's all these other sectors of the economy like 5G, cloud computing, AI, that sort of thing that are really going to support the revenues for these companies. We're looking at between 15 and 20% growth in earnings for these companies, which means that the whole process of how we value these companies is going to have to be reevaluated as we go forward. So, but we can take a look real quickly at AMD, Advanced Micro Devices, which is a pretty old company. They've been around, I want to say at least since the early 1990s. I'm not really sure. Earnings per share is about $2.35 per share. The price to earnings ratio looks more attractive than the company that I just showed you at $42. The beta is really high relative, meaning the volatility in the stock is really high relative to the rest of the market. Guess I was wrong about them being more stable. They are right in the middle of, or pretty close to the middle of their 52-week range right now. And like these companies are not necessarily cheaply valued right now by their current cash flows. But I think a lot of folks are taking a look at these companies right now and saying that they just don't, that regardless of what happens in the economy, they just don't see demand for semiconductors going away, and they don't see supply issues being corrected anytime soon. So yeah, let's talk a little bit about the current state of the economy. Yeah, so I get asked this every time I do a live stream. So I'm probably a little bit more bearish than I was a few months ago, but not deeply bearish here. I think that we probably are already in a recession, even though it doesn't necessarily look like a recession when you calculate in real economic growth, when you calculate in inflation. I think that while nominal growth was actually increasing, when you factor in inflation, we're definitely decreasing here. I also think that the Fed gave pretty good signals in the last week or so that they are far less concerned with maximum employment than they are with controlling with asset price stability right now, and with defeating inflation. And I think that is going to mean an economic slowdown. How shallow that is really depends on how long it's going to take to tame the inflation monster. And a lot of what's out there is not under the control of the Fed. They don't have control over snarled supply lines. In fact, I was just having a conversation with a friend of mine that lives in Texas, and I used to live in Texas as well. And most folks in the United States don't realize that the Port of Houston is probably like the second or third largest port on occasion. But right now, the Port of Houston is at capacity. They have no more room for anything. And so now they've shifted a lot of what used to be imported through the Port of Houston. They're moving it through the Port of Corpus Christi, Texas, which is a much smaller port and is a much smaller city. And so there's a massive wave of development that's probably coming to that city as well. And it's going to take a long time before they're able to take some of the pressure off of ports. And that's a lot of what is causing a rise in shipping rates, a rise in container rates across the ocean, a rise in shipping rates once it comes to trucking. Now, those have been dropping recently, but it's not really happening all that quickly. So I think that we've seen some encouraging signs with a decrease in the rate of the acceleration of inflation, and a decrease in the consumer price index, decrease in PPI compared to months before. But 1 month doesn't make a pattern. So we need more data to understand how much more hawkish they're going to be. But I'm fairly certain that next time around, we're going to get another 75 basis point raise from the Federal Reserve. And I don't think that the market has fully priced that in. I could be wrong about that, of course, but the old adage is don't fight the Fed. So I'm a little bit less optimistic about it than I was before. And the other thing that's out of the control of the Fed is the hurricane season. It's here. It could be really bad this year. As someone pointed out, though, predictions aren't worth very much. But if that happens and oil prices shoot through the roof, there goes all the progress we made on inflation. Because I think that majority of what is driving the decrease in inflation right now is the decrease in oil prices. Oil may still be below $90 a barrel. I'm not really sure. I didn't check oil today. You see here, yeah, crude oil down to $86.37. So it dropped a little bit further today by about $3.04. So that is an encouraging sign. Could turn around really quickly, though. If Russian oil is taken off the market completely, that is not necessarily a great thing for global markets. If countries out there who produce oil decide to cut back on production to maintain prices being high, that's not something the Federal Reserve controls. If we have a bad hurricane season, that's not something the Federal Reserve controls. If the war in Ukraine escalates and drags other countries into it, that is not something that the Federal Reserve controls either. If we have an economic collapse in China, which is looking more likely. I don't want to be alarmist here. I don't agree with the video that I saw that China only has 34 days before it collapses. They have a central government that has quite a bit more power than ours does to run roughshod over their own regulations and to do things that we can't. That has both good aspects and bad aspects. But no, I am a little bit less bullish than I am on the immediate term economy, meaning over the next 2 years. I fully expect us to have challenges, maybe not as severe as Jared Diamond does. And Jamie Dimon, rather. Jared Diamond is actually a famous author. He wrote Guns, Germs, and Steel. If you haven't read that book, that's one of the great all-time explanations for why the world looks like it does today. It's called Guns, Germs, and Steel by Jared Diamond. All right. But I'm talking about Jamie Dimon. He wrote something or spoke to some wealthy investors, and he said that there's a chance that the U.S. is heading into something worse than a recession. So that is an alarmist headline. What he actually did was report this offhand, sort of as a series of probabilities, rather than saying, we're heading to something worse than a recession. So let's read through what he actually said. He said the economy is strong, but storm clouds are on the horizon, including federal monetary policies, the invasion of Ukraine, rising oil prices, which aren't rising right now, but really could. But he warns of an economic hurricane. He also says that consumer balance sheets are in good shape, which is in direct opposition to what Michael Burry is saying right now about consumer spending really exploding right now. And he said businesses are equally in good shape. When you forecast, you have to think differently. It's a bad mistake to say, here's my single point forecast. And that's what went into the headline of that article and the tweets that followed. The CEO said that he estimated the chances of a soft landing to be about 10%. I would agree with that assessment, largely because the Federal Reserve has never really been successful at that soft landing, and the probability of a harder landing or mild recession to be closer to 20 to 30%. I'd say that's a fair estimate. He also reportedly estimated that a 20 to 30% chance of a harder recession. I would also agree with that. And a 20 to 30% chance of something worse. And something worse would be a collapse in China. And I really think that's probably what he's looking at right now. So Diamond had originally used the storm clouds metaphor to describe the U.S. economy back in April, but his outlook grew more dire in June. So he thinks there's big storm clouds out there. It's a hurricane, and you better brace yourself. JP Morgan is bracing ourselves, and we're going to be very conservative with our balance sheet, which is a great sign that banks are going into a recession or getting a bit more conservative on their balance sheet. And in recessions, a lot of times banks do not perform anywhere near as poorly as other companies do. So, yep. Still love Upstart. Actually, but it's a long-term investment for me. I've been grabbing shares in the $20 to $35 range as much as I can afford. But what I did with I recently sold some puts on Synopsys. I sold 3 contracts and I made like $940 or something like that. That money did not go into Upstart. It actually went into, did it go into VTI? No, it went into NOBL, which is a dividend aristocrat fund. So I am getting a little bit more, I'm spreading out my own investment money a little bit more as premiums roll in, or as I'm able to contribute money from what I'm earning. I'm spreading that out a little bit more and de-risking a little bit by buying some blue chips right now that I think are undervalued. So And Tell 666999 says, age of 44, I finally bought into my first Vanguard ETF, Vanguard equity funds. Always bought individual stocks. I've said this before that for stocks that are on the S&P 500, I find it hard to believe that you're actually going to score a giant win by something that's on the S&P 500, just because of the volume of information that is already available on those stocks. It's not likely that the market is going to overlook any of it. And I believe that almost everything on the S&P 500 is going to be efficiently priced. You only have small windows of chance to grab value. I think that now we're in one of those times, but even I am just buying ETFs at this point that are broadly diversified. I'm buying a lot of quality at this point, and I haven't seen a lot of value in the quality blue chip stocks over the last 2 years. What I've seen is they've been fairly valued based on current cash flows. Mid-June was when we had the best valuations I've seen in quite some time, and that we of course have lost a little bit of that with the run up. But I don't think that that market volatility is finished at all, and we're going to have more opportunities to invest. So little by little, I'm actually buying more ETFs right now than I am individual stocks. The individual stocks that I am buying right now are Upstart. I am not buying any more SoFi just because I have so much of it. I'm not buying any more Tesla just because I have so much of it. And I'm actually struggling right now to sort of figure out where I think the next 10 years is going, right? Actually, semiconductors are one of those things that I would actually like to see more trouble for this industry right now. And to give me a little bit better buy points into some of the things I'd like to own for that next 10 years. I think that this article that I just read kind of perfectly encapsulates my thoughts on the semiconductor industry, that the cyclicality of the semiconductor industry is becoming a thing of the past, as it's no longer dependent on retail sales of consumer items. So yeah. Michael Will says, I've been a bit lazy. I hold NVIDIA and the SMH ETF. I don't think that's lazy at all. I think that's a smart thing to do, to have a broadly diversified basket of semiconductor stocks, and then to take a concentrated bet on something that you think is really going to dominate over the next decade. NVIDIA is likely to be one of those companies. So you wanted to talk about Intel stock? Let's talk about Intel stock. Once again, though, that is something that is on the S&P 500. And so it'd be hard for you to, really sort of outsmart the market here, because there's so much in the way of information out there, and all that information is instantly public. So Intel Corporation is trading at $36 a share right now. Price to earnings ratio is 7.77. Earnings per share is 4.66. What I haven't looked, and this would represent a great value, especially with the dividend yield being at 4.02%. Do you think that the stock is at least going to average 6% return over the next 5 years or so? It would look like a fairly decent value if you think that capital appreciation is going to be higher than 6% or so. I would like to get 10% a year out of any individual stock that I own as a bare minimum. I think that the next 5 years or so, Intel's probably going to blow that estimate away. Here's what bothers me, and it only bothers me because I haven't done the research yet. How dependent are they still on the PC market? What sort of penetration do they have into cloud computing and all of these new areas like AI? So those are the things that I haven't investigated Intel with lately, and that's because I don't hold it as an individual stock anymore. This could be a really good individual holding for someone in their portfolio. It's pretty close to the bottom of their 52-week range right now. Like I said, earnings per share of 4.66, price to earnings ratio of 7.77, a low beta of 0.62. This is something that Warren Buffett will be looking at right now in terms of a value stock. It does look like it represents value. It doesn't really look like a value trap at this point. And let's see, they haven't really capitalized on a ton in the last 5 years or so. Yeah. So no, I think this could definitely represent some opportunity. Let's take a look at earnings here. Yeah, and the volatility doesn't have much to do with their earnings or their revenues. They've steadily increased revenues over the last couple of years. We've seen a slight decrease in earnings, and that is to be to be expected as they are spending a lot of money on research and development. We do have a couple of sell recommendations over the last couple of months, but most people have hold, buys, or strong buys. I would definitely say that this looks like a buy, not necessarily a strong buy, but I would need to investigate them a little bit more. I'm a little out to date on Intel. It's not a stock that I've been interested in a while. So when the Taiwan struggle settled down, I would recommend HIMX chip company paying a dividend, making a profit, and a PE of 275. So um, actually, I'm not worried at all about what's going on with Taiwan right now. That is just political posturing, people doing military exercises. The United States and North Korea have been trading military exercises now for 40 years or something like that. It looks like China and the United States are going to trade military exercises over Taiwan for the next 40 years or something like that. I don't think that China sees it as in its best interest to change the economic system of Taiwan. They have, to a degree, done that with Hong Kong. I mean, they haven't changed that much about the capitalist system, but they've definitely changed a lot about free speech there. We'll have to see what the long-term economic impacts of that are. But this is not a company that I'm enormously familiar with. Let's take a look at that real fast. So I really don't like Yahoo Finance's format, but the website that I was using was behind a paywall to do this. I got a complaint when I used it on a live stream, and also it was too small for anyone to read. This is actually kind of too small for people to read too. But let me see if I can zoom in here a little bit. All right, so that's a little bit better. But yeah, so it's a very volatile stock with a beta 1.92. Price earnings ratio is 2.75. Earnings per share 2.56. Volume is high with 2 million shares. That's good. When you see the price of a stock like this with the low market cap of 1.2 billion, you generally don't expect to see volume this high. Dividend yield at 16.6. That dividend yield is actually more of a warning sign than it is an encouragement. Typically, if you see a dividend yield for a stock like this over 5%, then they don't think of themselves as a growth stock, or they've had some recent catastrophe or something that's brought their stock price down. That dividend would probably not be sustainable over time, but you have to take a look at payout ratio to really understand that. So, and they just cut their earnings per share forecast substantially. Not a lot to go. Okay, so their earnings have really increased over the last year or so. Their revenues really increased over the last year or so. It's a little bit early in the data here for me to talk about this. This is not a company that I'm that familiar about this, but an intrinsic calculation for Himax Technologies suggests that it's 46% undervalued. Look past the headlines, guys. Take a look at that and see if that's something that you're comfortable with. I would say that there's a lot of opportunity for double-digit returns in some of the larger, more established players with solid balance sheets, a great suite of products, and they have war chests and orders that are going to keep them going already for the next 2 years. So, whoops, here we go here. Hi, Jason. Back on the stream finally, as I've been ill with COVID. At the local level, have you seen cost pressure at your bar and as consumer? So consumer demand is not dropping off, but I know quite a few people that own bars, restaurants, cafes, all that kind of stuff. The two things in California are, of course, the price of labor, which is higher than the rest of the country because we have a minimum wage of $15 an hour. And places like Texas have a tip wage where waiters there make $2.13 an hour plus whatever tips they bring in. I am not exaggerating this. This is what they make. And standard tip when you go out to dinner or have drinks is anywhere from 15 to 20%, depending on how cool your customers are. And I'm not kidding. Like I tip usually, even for bad service, I tip a minimum of 20% just because I know how hard the job of being a server is. If you've never worked as a server, if you're ever unemployed, I suggest you go do that and understand just how hard the job is and just how hard people have it in the industry. And you'll understand there is a certain class of customer that doesn't go out to eat. They don't go out to to have drinks. They go out to treat somebody like crap. And I'm always very generous when I tip usually, and especially at my own bar. But no, we have seen cost pressures with food and everything and labor going up, but we have not really seen a drop off in customer demand. Part of it is I think just people are ready to go out and mingle no matter what. They've been careful, even if they didn't like it, they were careful for the last year and a half, 2 years, and now they're ready to go out and mingle. And I don't think anything's going to stop them at this point. And this is one of the things I've had a talk with my business partner that even if inflation rises, even if we go through a recession, with the bar in particular, we think that place is pretty much unstoppable, just absolutely unstoppable. And how was the barbecue? The barbecue was amazing. I had all of my jiu-jitsu students over at my house and a couple of friends too. And it was great. But that is where I really noticed pricing pressures on food. When I went out to buy, and I end up buying sometimes like a whole chuck roll to smoke. I don't smoke it whole. I end up cutting in pieces and smoking those individually. It was way higher price than I remembered. Pork prices were up as well. I didn't do any chicken for this barbecue, but pork was up quite a bit and beef was up astronomically. So that was actually pretty expensive. So that was a real eye opener, and largely because I haven't actually been subject to a lot of the pricing that's gone up since April. When there was a big sale on meat and a lot of other things, I bought a bunch of it in April, stuck it in my deep freezer out in my garage. And also my garden outside is producing food like gangbusters at this time of year. So I really don't go for much besides, milk for my kids and a few things like frozen noodles that they want to eat or rice or something like that. Those are about the only things that I go out to the grocery store for. So I haven't seen a lot of the pricing pressure until now. But yeah, I definitely witnessed it. It is going to be hurting people at the lower end of the economic scale. I grew up in a place where we didn't have a lot of choices as far as where you could buy your food. And the price at Klein's grocery store was the price at Klein's grocery store. And you only had one other option at that time. Of course, that place has changed. But if you couldn't afford it at those two places, you just couldn't afford to eat meat. And that was a frequent occurrence for people on the lower end of the economic scale of my town. But yeah, that's one of the things that is really discouraging to me is that food prices have really risen over the last year or so. And I don't think anyone should have to compromise on the food that they're eating. That is essential to life and essential to happiness. So, hey, Jason, what sorts of acquisitions do you think SoFi could be looking to make next? Honestly, because they have so much cash on their balance sheet and because they are in acquisition mode, I would expect them to, and because they want to become a lender, more than what they're doing right now. They don't want to facilitate loans for other loan providers, which is what they do a lot of right now. They have a bank charter. What I expect them to do is go out and acquire banks. They want them for the deposit base, and they want them so they can have a wider base there to loan from. So they're going to use that deposit base, whatever that bank deposit base is, to actually make loans to their SoFi clients. So look at them to acquire regional banks that you probably never heard of. That's probably what's coming next. So I know that leveraged ETFs are dangerous, but I'm curious about how the time decay works. Do you understand them? Is the time decay over one trade over several? You can experience time decay over several trading days, but it's really, if you try and hold on to it for like a month or more, you're going to underperform whatever the underlying asset is. It's just basically the way that volatility works. Let me explain it this way. If you own a leveraged ETF on a stock that's $100 a share, and it goes down by 50% in a day, because it actually is like an inverse share. So it went up by 50% a day. So now your stocks are down 50% a day, right? Let's say it's not even leveraged. And then it goes up the next day, 50%. Well, where are you? You're not back to $100. You're at 75, right? So magnify that with leverage, right? With a 2 times and 3 times, you guess wrong a couple of days in a row, and now you're never going to recover that asset because you have to get higher and higher gains to do that. So I did actually really well with leverage ETFs during the economic crisis in 2008 when these were new assets. and then later on trying to do it in the opposite direction on the way up because of the volatility in the stock market, because it really was up and down, up and down, up and down, 2008 to 2011 or so. I ended up getting burned on those ETFs. And I haven't gone back to do the math, but I probably really didn't make a lot of money before I stopped using those. So yeah, the time decay on that is real, and it has everything to do with the volatility of the stock and what it takes to recover, on how many consecutive days of equal or greater return you need in order to make that money back. So Chris Palmer says, hey, Jason, started a new job. Is there any reason not to participate in my 401k with a match? Generally, no. Especially if the match is what's called the safe harbor match, where you contribute 6%, they contribute 0.5% up to 6%, which is 3%. It's a guaranteed 50% return on your money. There are a few exceptions. I did look at a dentist's, and the guy was a little bit odd right off the bat, and I knew something was going to be weird. But he walked into the bank that I worked at a long time ago. It was a regional bank here in California, and said, hey, I have a 401k. My employees are complaining about it. Can you take a look at them and tell them that it's fair? Number one, you probably shouldn't start a conversation with that with someone who's supposed to act as a fiduciary. It doesn't matter if you work for a commission operation or whatever. When you're working with, meaning you're selling investments for commission, if you're also licensed and you sell 401ks and you talk with employees about that, you're required to act as a fiduciary, and you're not actually allowed to make recommendations to buy, sell, or hold any security in the portfolio. So you have to act as a fiduciary. So I remember walking into that office and taking a look at the 401k, and he was essentially forcing all of his employees to invest in raw land deals with him. And he had found a way to do that through a 401k program that we didn't offer. And he matched, but he matched in a weird way too. And there was a really long vesting period. So you can do like cliff vesting. You can do right-away vesting. You can do cliff vesting, where you vest a little bit each year. Then at year 6, you get everything. But most people do like gradual vesting, like at the end of every year. Some of your stuff vests and some of it still. But even vesting is going away right now. A lot of companies just let you keep whatever is in there. So So generally not if there's a match. Especially almost every 401k right now offered with an employer is going to offer you, an index option that's in there. That's probably the better option and the cheaper option to take. Your actively managed funds inside of your 401k, depending on the size of the company you work with, those fees inside of those funds could be a lot higher than you think. They were roughly, when I used to do this a lot, the fees could be as high when you combine everything together with all the administration fees associated with the 401k, as far as the management fees and the program fees and all that stuff. It was as high as 2.75% annually on your balance. And then when you look at the index funds inside of the same portfolio suite that you had there, they were about 0.25%. So I would suggest taking a real close look at the fees that are inside of there. If it's higher than about 0.75% and it doesn't have outstanding performance, then it's probably not worth it. But you can do what's called time value of money calculations, where the difference is, between you paying a management fee of 0.75% and 0.25%, and it's hundreds of thousands of dollars over the life of that program. Also, rolling out your 401k money into an IRA, be very careful if you use an advisor as far as what investments they want to put you in or what you're going to do with it. There are a lot of bad 401ks out there, but there are a lot of them that are fantastic. And most of your S&P, your Fortune 500 companies actually have really inexpensive 401k plans. It's the mid-sized companies and smaller companies that don't know how to look at, negotiate, or really understand a 401k agreement. That's where they're getting ripped off, and it's usually these smaller not these wirehouses that are selling these. So yeah, so let's talk about with Terrence Nuon. Let's talk about Skynet. I'm just kidding. It's Skywater Technology. Not a company that I am familiar with. Up 33% today. Negative earnings of $1.69 per share. 52 range kind of smack dab days range smack dab in the middle of it. 52 week range also smack dab in the middle of it. Highly volatile though. Small market cap of under $1 billion. Volume today was super high, and with 2.5 million shares, which is roughly 9 times average. So it's way above the 1-year target estimate. Semiconductor manufacturing company. Let me see here. Let's take a look. Let me see here. Yeah, and I think we're going to see more of this where these companies are not, some of these companies, these smaller companies are going to blow away estimates because they were really expecting, analysts were really expecting more of an impact. Actually, I think I haven't. Okay, so I can still look at some of these. So they reported top and bottom line second quarter results that outpaced analyst average estimates, up 32%. So the loss per share was worse than the company's loss a year ago, but still ahead of Wall Street's consensus estimate of 34 cents per share. Second quarter revenue was 47 million, up 15% year over year. The beat analyst estimate of 44.5 million, but it's not above kind of what the industry expects right now, which is somewhere between 15 and 20%. Investors were clearly happy with better than expected results. I think what they're really happy with is not as bad as we thought results. We're likely impressed by some of its highlights from the quarter. Skywater said it started a new partnership with the state of Indiana and Purdue University to build an advanced $1.8 billion semiconductor factory on Purdue's campus. Well, that is a major catalyst. Okay. Additionally, the company said it received a $15 million investment from the U.S. Department of Defense to fund an open source semiconductor design partnership the company has with Alphabet's Google. All right. Interesting developments. Now what? In addition to strong quarter results, investors may have latched on a recent positive note from Piper Sandler analyst who raised his price target from 10 to 18 and kept an overweight rating on the stock following the company's release of second quarter results. The latest results were solid and thinks that Skywater could benefit from the recent passage of the CHIPS Act, which they could. They're a U.S.-based chip producer, which includes $52 billion in funding and tax credits. Yeah, not a company that I was familiar with, not one that I had my eye on, but especially based on that news, things look pretty good for that company. I'm going to put this one actually on my watch list and keep looking at it here. I don't ever want to jump into something after it's gone up by 32%, 33% in a day. Doesn't mean that it won't go up further, but there's likely to be a retracement in the next couple of days. That's a lot of enthusiasm here. Yeah, was it you that actually posted something on my Patreon this morning about this company? Because somebody else posted something about that this morning. I think that was you. So I did look at them pretty briefly, and they are relatively concentrated on everything that has to do with battery technology. So nickel's kind of interesting. It has a lot of industrial applications apart from just EV batteries, and there's going to have to be a pivot away from some of those other industrial applications by companies that already mine nickel, or new companies or new divisions of companies are going to step in and mine more nickel. But like I said in my Patreon group this morning, in the future, it's actually not likely that vehicles that are intended for the mass market are going to have nickel in cathode chemistry. It is just too expensive. We're probably looking at alternate chemistries kind of dominating here. We're probably looking at lithium iron phosphate batteries serving the mass market, meaning for vehicles that are priced under $40,000 or so, or maybe that's $50,000 today with all the damn inflation we've had. But that's a possibility. It doesn't mean that nickel's not going to be seriously in demand. It is. I just don't think it's going to be in every electric vehicle going forward. We're never going to have enough mining going on to fulfill that. It's not rare, but it's not all that common, and nickel deposits tend to be more concentrated than like lithium does or something like that, or even iron is. So Elon Musk stated, please mine more nickel. We will give you a giant contract for a long period of time if you mine nickel efficiently and in an environmentally sensitive way. No one's ever going to figure out how to mine in an environmentally sensitive way. I think that is just delusional. And I think that it's virtue signaling. It's the way metals are mined out of the earth. It's not. It's going to be massive strip mining, and maybe there has to be some program of land remediation or restoration afterwards. But it's not going to be done really in an environmentally sensitive way. Yeah, and this is the article that was posted. I guess it was you that posted, Demos, that Giga Metals and Mitsubishi said they intend to make turn again one of the greenest and most environmentally friendly nickel projects globally. And that is the article that, or I don't know if you posted it or I went and found it on the internet this morning. But yeah, I was reading one of those too. So I do think that nickel demand is only going to rise. I don't think it's going to be so incredibly important to electric vehicles going forward, except for the highest energy density applications, like the luxury end of electric vehicles, or even possibly for EV flight, right? Or for VTOL or something like that. That's probably where it's going to end up, just because it's more expensive and those higher margin vehicles can absorb some of that cost. So, server here, I made a man angry last week when he left me 10%, whatever. I can't even tell you how many times. Now, granted, I was not a good waiter just because I'm extremely scatterbrained and I'm not that great socially. I wasn't a great bank teller either. I did all those jobs when I was much younger. I can't tell you how many times I got left no tip. And I worked in a town that periodically had a lot of like religious groups come in for conferences. And whenever one of them was in, I could guarantee you that half of my tables were going to stiff me. Guarantee it. I don't know why. I have no idea why, but I'm guaranteed that half my tables would leave me no tip whatsoever, and a couple of them would not even pay and walk out. So they'd make up some reason to be upset. But that is one of the things that I experienced as a server that was absolutely infuriating. Here in California, like I said, we pay $15 an hour plus tips. And it means that it's very expensive to live here. Let's face it, California is the high stakes table in terms of trying to make it here. Like, you don't walk into Vegas and sit down at the table that has a buy-in of $100,000 when you've only got 10. I usually, if I go to Vegas and I want to gamble and I want to play blackjack, I'm going to the $10 table because I don't want to lose a lot, right? So California is kind of that way. If you make that Vegas comparison, it is the high stakes table. Even $15 an hour plus tips, if you're not a good waiter, it's not going to be enough to survive on. So, yeah. So he also said his company, the man who stiffed you, was worth over $100 million. Mainline fifth. So he left you a 10% tip when his company is worth over $100 million. I'm not worth anywhere near $100 million, but even when I have bad service, I'm always empathetic. You can't teach empathy, and that's what it comes down to, is you just can't teach empathy. At some point, you just throw up your hands in frustration and walk away, because you can't teach people to be empathetic to your situation. They either are or they aren't. And I say this as someone who struggles to have empathy with people. So, yeah. Let me see here. Clearly a silly question for me. Inflation brings the prices up and stays there. Do prices ever come down as negative inflation? Yes and no. Yes and no. It really depends on what's going down or what's going on with the supply and demand curve of whatever is being bought and sold. So inflation tends to be persistent, meaning that once it happens, we tend to see a ton of deflation. But that is exactly what so deflation also tends to be a self-feeding cycle, meaning that if prices start to come down at a rate that's really quick, people will delay purchases of items in order to helpfully catch a better price on the way down, which of course decreases demand and causes an economic slowdown. So that is not something that the Federal Reserve wants either. So if you're expecting prices, your central bank, wherever you're located as well, they don't want that to happen either, because it will come with a massive economic slowdown. They would like to see a stabilization of prices, and as we go forward, we'll just get used to higher prices, right? But they don't want to see deflation either. That's a deflationary cycle is something that is just as dangerous as an inflationary cycle. What everyone wants worldwide is prices to increase between 2 and 3% annually. This is how fiat currencies have to work. Yeah. But no, prices on an individual item or class of items can definitely come down because of changes in the supply and demand curve. But it probably won't be as a function of deflation unless there's a disaster. When you said you'd be looking to take a position in ARM when IPOs, do you think it's worth it to wait a few quarters to receive the results or DCA from IPO? I think it's worth it to wait a few quarters to see results. But the issue is that ARM is likely to publish all the financial information well in advance of any IPO. And so you're going to be able to see several years worth of data, quarters worth of data going back several years, and you'll have a better idea of what their earnings growth is like. It's not going to be like a lot of SPACs that are pre-revenue companies where their books going backwards are really suspect. ARM is not going to be in that category. You could have a fairly good idea of what their current cash flows are going to look based on the information that's going to be published in their investor deck. And I think it's going to be much more reliable than, I did a video where I worked really heavily off of, SoFi's investor deck. And that was back in like January of 2021 or something like that. Or I think it was back then. And there was always the chance that they were just not being truthful about the revenue growth and member growth and product growth of that company. There's always that chance. It turns out they were looking like they were fairly truthful at this point. ARM, on the other hand, they'll have their crap together before they IPO. Even if it is a SPAC, this is a company that's going to be a lot more professional about it. And it looks like they're going the traditional IPO route. So yeah. All right, guys, good questions today. Really good questions today. Keep firing away on those. Oh, we're already at an hour. Okay. What I mean is items go up due to inflation, by example, 10%. That's the price for an item. Inflation is never in the negative. So if wages go up by inflation, we'll always lose out. For the most part, if you're at the same job you have now and you haven't gone to look for a new job in a high inflationary environment, you will lose out. The best way for you to get a wage raise is to change jobs. At least that is true in the United States. I know that it's a lot harder for people that live in European economies to switch jobs or switch careers or find a new role at a different company. In the United States, though, work mobility is fairly high. I was reading somewhere that in the past, like 70 years or something like that, the average American changes cities every 5 years. That has not been the case for me. I've been in San Diego for quite some time now, but prior to settling in San Diego, I moved every 2 to 3 years for a better job. That's just what I did. So, yep. Let's see. Do you mean NU or Micron? MU. Can you clarify whether you mean MU or new holdings up 17%? Yeah. The overriding theme of Q2 earnings is that it is not as bad as we expected. That is absolutely the overriding theme of what's going on there. So I hope I'm looking at the right stock here. Okay, market cap of 25 billion, earnings per share 7 cents, 113 million shares, average volume 31 million shares. We're talking about Nucor here. New holdings. Sorry, it's a digital financial service delivery platform technology company primarily based in Brazil, Mexico, and Colombia. It offers new credit cards and debit cards, ultraviolet credit and debit cards, mobile payment solution. Man, there are tons of these services. You guys are familiar with like DaviPlata or Remitly, and there's tons of companies that are serving Latin America now, and they're really bringing the average Latin American into the global financial system right now. And I think there's actually a lot of investment opportunity there. This company has incredibly quickly growing revenues. I would want to know a little bit more about this, but yeah, they beat in Q4 2021. They beat earnings. Let me see here. Yeah. All right. So it looks like they beat consensus here. Let me see. Definitely. And I'm almost over a lot of articles of free Motley Fool articles. And if a bunch more of you guys sign up for my Patreon, then I'll sign up for Motley Fool's get behind the paywall stuff too. That's what I use to access some of my premium news sources. And I take Motley Fool stuff with everything with a grain of salt, not just Motley Fool. I'm still bitter about Westport Energy's recommendation for Motley Fool, by the way. The second quarter increased by 232% from a year ago to 1.2 billion. That's easily outpaced the consensus of 907 million. The GAAP adjusted earnings are flat year for year, and that's because of increased expenses. Largest banking operation in Brazil with 13 million in net profit the first half of the year. Strong quarterly growth. It's up 17.5% today. Yep. So SoftBank owns 22 million shares of the company. Don't be surprised if SoftBank uses this as an opportunity to divest themselves of some of their shares. SoftBank is in trouble. They're de-risking their asset balance sheet right now. They've sold a number of holdings. Alibaba recently, SoFi, I think C Limited. They divested themselves of a bunch of shares of C Limited. But yeah, so yeah, don't be surprised though, even though they're giving their stamp of approval, if they decide to go ahead and sell shares. Oh, Michael Will says, oh, I did not. Chris, thank you so much for the super sticker. It is well appreciated as always. And that's for the 401k information. So let me see here. And Deepak says, will Chinese stocks ever come back up again? Howard? So I think they'll come up again. The enthusiasm for Chinese stocks with U.S. investors is always a little bit difficult to understand. The most popular companies here on U.S. markets are a lot of times not even household names in China itself. Like you can't, if you go to XPeng, if you live in the south of China, you know who XPeng is. If you go to the north of China, you probably don't know who it is. And the same thing as Li Auto, except that maybe in reverse order. NIO is known nationwide because they've been featured, pretty heavily by media. But a lot of the companies that we invest in are not household names in China. They used American capital markets to raise money to expand operations in China. But a lot of times the picture you get when NIO is being called the Tesla of China way back in 2018, 2019, wasn't even close. And no one had any business calling it the Tesla of China. And I think I even made like a clickbaity sort of thumbnail on one of my first videos that did really well about NIO, saying NIO is a better investment than Tesla. It's obviously not a better investment than Tesla is. I think NIO will do just fine. But at that time, no one had even heard of it in China. It was something that was more popular here in the U.S. And all of those stocks were more popular here in the U.S. than they are in their home countries. You're looking at BYD vehicles being vastly more popular than NIO vehicles are, even though this company gets virtually no attention inside of the United States. They're selling, they're going to sell something like 1 million vehicles this year, better than 500,000 of them electric vehicles, whereas NIO is going to struggle to produce 200,000. XPeng is going to struggle to produce 200,000, and I think it's about 1.7 million vehicles is what BYD is going to sell this year, with about 1 million of those being either hybrid vehicles or electric vehicles, roughly half of those being electric vehicles. By far the largest electric vehicle producer in China right now, and rapidly catching up to Tesla, and they may have even passed Tesla up for at least 1 month this year. So what we think of as a great company in China is really skewed by what other people are saying about Chinese companies here in the US. It is not always necessarily a reflection of reality. Every single brand in China now is producing an electric vehicle. Every single brand is either producing their own luxury vehicle or a spin-off brand, including NIO. They have a cooperation with a company called GAC, and they have another like luxury SUV brand. But they have a lot of competition in that country, and for a variety of reasons, I think that we are misinformed as far as how important these companies are to the consumer in China. They're never going to grab larger than, say, 13 or 14% market share. That's never going to happen. And it has to do with how the markets are structured, how you get manufacturing permits and all that. And the fact that every foreign company is also selling in China as well, because it represents the largest and fastest growing car market in the world. So, all right, guys, thank you for the super sticker today, Chris. Thank you for also being a part of my Patreon as well. I am going to sign off for today. I've been on a little bit longer than I intended to, and I have a few things I need to do today. But once again, I'm looking forward to seeing you guys tomorrow. We'll talk about some of the other things that are going on in the market. I did want to cover semiconductor chips or chip manufacturers today. I think they do represent some very, very long-term value. And I'm saying, look at what the economy is going to do in the next 10 years. Do you actually see the demand for semiconductors declining in the next 10 years. I do not. I see a decline in the cyclicality of the business, meaning that the current cash flows and demand from non-consumers are going to help support demand like it didn't happen in the past. But thank you so much, guys. Once again, not a recommendation to buy, sell, or hold any security aimed at any individual, and I'll see you tomorrow.